Gregg, you've been with JWB for 15 years, and we got a bunch of newbies here on the chat, and they better get ready because it is live on Facebook for the Thursday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, my co-host, the man they call GC, because he just garners credibility everywhere he goes, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. Great to be with you here to kick off 2021 POT Dubs style. There we go.
For those uninitiated, POT Dubs means the rental income property of the week.
Week.
And we have a good time with this. So before we get started talking about a property that we're going to stick our fingers in and get to know it, I love all the new people that are chiming in the chat right now. We got Saba, who came with us from Keith Weinhold and Get Rich Education app. Very, past guest of the show. We got Pratap coming to us from the Cape Cod, Massachusetts. We got, Larry Morrell, first timer from Seattle, Washington. Beautiful part of the country that I've been dying to check out. And just so you know, this, as much as any other show, right? Like these are all interactive. Tuesdays are interactive. This one's interactive. But this one really is all about you because Gregg knows his numbers. Gregg knows what these properties look like. We're going to be describing them, and we want you chiming in. The two ways to be a part of the show: you can chat with us in the chat box, and there's a little trick to the chat. When you open that chat box, the little blue button above where you write says panelists. You want to drop that down and put panelists and attendees so that you can be seen and read by all the other extraordinary, not your average investors that are here with us. You will probably make a new friend in this chat. There's a lot of common knowledge with our regulars that show up every single week. So we want you interacting and we want you becoming friends with each other. And then if you want a question asked on the show, two ways to do that too. You can pop open the Q&A box and type it in there, and that is the best way for me to ask Gregg the question live because it holds there as the chat is going crazy and people are talking. And then we just started implementing this a couple weeks ago in our fan appreciation show. There is the ability to raise your hand and we bring you live. We are still in experimental stages with that, but we're open to it if you're open to it. So give it a shot if you want. If you raise your hand, I'm going to chat with you and make sure that you didn't do that by mistake because that's happened in the past too. And then I'll bring you on. But without further ado, if you just want an overall breakdown of passive investing, how it fits into your portfolio, and the JWB method that makes it really, truly passive for you, go to jwbpassiveguide.com, download your copy, and you're gonna learn about JWB's world and everything that you want to know in there. That is your next step for those uninitiated. Highly recommend that resource. Without further ado, Gregg, are you ready to get into this property, buddy?
I've been waiting for like 3 weeks for this, man. If I wasn't ready before, I'm 3 times as ready now.
Reminds me of that Phil Collins song. He's like, I've been waiting for this moment. All right, here we go.
All my life.
Unfortunately, this does not have a name that I can play off of, right?
Yeah, good luck with that. I gave you a lot of numbers.
Yeah, that's why I had to go Phil Collins. 9144 5th Avenue, Jacksonville, Florida, 32208. It is a home under the purchase price of $122,000. Beautiful looking little 3-bedroom, 1-bathroom home with a carport, an estimated rent range between $875 to $925 a month. And let's see what you are really looking for here. What people are buying when they buy into this asset class is right here. It is the estimated conventional financing total monthly cash flow of $194 per month and an estimated conventional financing total ROI of 9.74% per month. Gregg, I was just describing it for our folks that are just listening on the podcast at some point in the future here, but let's get into these numbers. For those uninitiated, tell me what is included. What is this $194 per month monthly cash flow really mean?
Well, the reason that $194 is really important to you is because when you're investing in rental properties, the first rule of rental properties has to be that the asset needs to pay for itself, meaning that the income from the rent needs to more than cover what the expenses are for that property. And so when you see $194 there, $194 isn't going to change your life, but what's significant there is you have an asset that is more than covering all the expenses, including the debt that you have on the property. And that's one thing that separates rental properties from other asset classes, is that it pays for itself. It brings in income. And when you have additional income over the expenses, that is one of the 5 profit centers of rental properties, and something that makes this, in my mind, something that is scalable, right? Because if you have assets that pay for themselves every single month, this idea of growing a portfolio from maybe 1 property to 3, 5 properties or 5 properties, it becomes possible, right? If we think about it from a different perspective, if every time you bought a property, you went $300 in the hole every single month, you're not going to be that excited to build up a portfolio of 3 or 5 or 10 rental properties. So it's incredibly important to buy assets that pay for themselves every single month. And specifically that $194, what that means is the cash flow that you're going to receive on a normal month. When I say a normal month, that means a normal month where the home is rented. This one happens to be already rented and is cash flow positive from day one for the investor that does purchase this home. So that's really incredible. And then on all of those normal months, when the rent is coming in, we're going to take out the cost of the debt, meaning your principal and your interest payments. We're going to take out the property taxes that you need to pay. We're going to take out the insurance costs that you need to pay. And we're going to take out the property management fees. Because for most of you who are listening here, you're interested in the passive way to invest in rental properties, which means hiring a property manager to do that for you. So we're going to include that cost. You take all of the income that comes in minus all those expenses that I just talked about, and it's going to leave you with right around $200 a month for this rental property.
Got it. So you said something, and I normally don't start off here, but I feel like there's a lot of new people here on the call today. You mentioned that is one of the profit centers. Can you go quickly into the profit centers of rental property investing so that everybody understands it?
Yeah, and this is so critical. You take what I'm going to share with you, these 5 profit centers, and you compare it to other asset classes, and most other asset classes really just can't compare. This is why, in my humble opinion, I believe rental property investing, specifically in single family rental properties, is the best risk-adjusted return on investment. Risk-adjusted for me takes into account a couple of different things. Like number 1, the first profit center is positive cash flow, like we just talked about. Well, for me, if I invest in an asset and I don't see any money coming in on each month or for many years, many investments are that way, that's more risk to me, right? I've got to put more money out and hope that it's going to come back at some point, right? That's inherently more risk. And that's what a lot of other investments ask you to do. Well, in rental properties, if you invest in a market like Jacksonville, where you can get investment properties where the rent more than covers all the expenses, that's taking a lot of that risk off the table, and it becomes a scalable model for you as well, right? Again, the alternative would be if you had to go in the hole every single month, you're not going to be so excited to buy those additional assets because it's creating more and more risk every single time. Well, you don't have that when you invest in the right market like Jacksonville. So that first profit center is positive cash flow, like we just talked about, roughly that $200 that we were just sharing there. Shall I proceed?
Please. So you got cash flow covered. I'd love to hear the others.
We got cash flow covered. Another profit center is tax savings. So again, comparing other asset classes to rental properties, we have built-in tax saving mechanisms here that just aren't available in other asset classes. And you get to write off a lot. You get to write off your loan interest, all of your maintenance costs. You get to write off your insurance costs, your property taxes, your property management fees. You get to write all of that off. But the one thing out of all the write-offs that I love the most is property depreciation. And when I say depreciation, I'm strictly talking about it from a tax perspective. I am not talking about market value. Some folks get confused there. When I'm talking about depreciation here, I'm only talking about it from a tax perspective. And this is the type of depreciation that you want. All right. So the way depreciation works is the IRS gives you a write-off every year when you own rental properties that you can use to offset your gains in passive income rental properties. Whether or not some of this stuff breaks every single year, you're going to get this write-off, which is incredible. It's a non-cash write-off, right? A cash write-off would be something like property management fees. You had to pay those, but sure, you get to write them off. You would much prefer non-cash write-offs, things that you didn't actually have to spend money on, but you still get to write it off. And rental properties allow you to do that. It's what separates this asset class from just about every other asset class out there. So that is responsible for your tax savings component, and that is the second of the 5 profit centers. Next, we have principal paydown. So principal paydown is sneaky fun. All right, sneaky fun, I say, because it's not something that you're going to see in your bank account every single month, but you are really going to notice it. And what's happening is when you invest in an asset that has positive cash flow, part of that expense that is being paid is your loan principal balance. And so as your resident, some of you may call them tenants, I call them residents because they stay forever, right? When your resident is paying that rent to you, they're paying part of your principal loan down, which that happens every single month. Every single month. It might be a couple $1,000s of your loan is paid down after the first year. And then every single year, incrementally more of your loan is paid down and paid down and paid down. And you wind up in 10 years or 15 years or 20 years or whenever the loan is paid off, and that thing is completely paid off. And what that means is that you didn't even have to experience property appreciation for you to have a huge equity gain here, right? And if you invest in a market like Jacksonville, we'll get to the next profit center, you probably do see home price appreciation. But even if you didn't, your resident paid that loan down for you. So a huge profit center, you're not going to notice it in your bank account. It's going to sneak up on you. You're going to look at your loan balance in 5 years and be like, wow, that's way down. That's really cool. I didn't know that. Maybe I can do a cash out refinance.
Sneaky good. Sneaky good.
Sneaky good.
Greg,
I like that one, huh?
Yeah, because I've been around around the block here on a couple POT dubs. I'm going to stop you right there. Those 3 profit centers, and I want you to talk about this total ROI as it belongs to this property. It says 9.74% under conventional financing total ROI. Can you put that 9.4% into context?
Yes, absolutely. I'm glad you stopped me right there because those 3 profit centers are encapsulated in this total return on investment, as well as additional expenses that you will see at some point. So that 9.74% return means that when you look at all of the rental income that comes in, you subtract the things that we talked about, like being on a normal month, your principal, interest, taxes, insurance, and property management fees. We're also going to take away the expected maintenance cost and vacancy cost that you will most likely have. We know that you're going to have these, and we know with a high degree of certainty what they will be over time because we've tracked all of our clients' properties since 2011. There's over 2,000 properties that we track every single month. And so it's not a surprise for us. We know with a high degree of certainty what your maintenance costs and vacancy costs are going to be. You'll find them on the evaluation. I'm sure we'll talk about it here in just a second. But we're going to include those as expenses, take away from your return there. We're also going to count in the 2 profit centers that we just talked about, the tax savings component and the principal paydown component, because they are profit centers for you. We're going to take that net amount and we're going to divide it by your initial investment. And your initial investment includes your down payment as well as your closing costs. And for those of you out there that are investing maybe with other providers or in other markets, don't forget to include your closing costs when you're making your decision based on your returns on investment. Most turnkey providers do not include those, but we do because guess what? You're going to see them when you buy a rental property. I haven't figured out a way to buy a rental property without any closing costs. So, and I don't think you have either. So you should probably include them. We take all of that. We take the net total return from those 3 profit centers. We divide it by your initial investment, and that's how you get this 9.74% return that we have on Fifth Avenue.
Love it. Greg, I'm going to ask you one more kind of pre-frame question that we like to go through when we start these shows because we already have a ton of questions here in the Q&A, and I want to get to all of them, right? So the last thing I'm going to ask you about here before we get to just straight user-generated questions is, what's up with the 0% appreciation rate, man? I thought you said that was a profit center. What's going on there?
Yeah, well, you know, and I did. You totally had an awesome segue there because the 4th and 5th profit centers I should probably talk about. So the 4th one is home price appreciation, right? This is the reason that people come to Jacksonville. If you're a rental property investor and you are looking for a combination of both positive cash flow and higher than average home price appreciation, I would really challenge you to find a market that has better numbers than Jacksonville. You probably can't find it. What happens when most people invest in rental properties, they either go too far in one of the directions. They either go too far in the direction of positive cash flow being the most important thing and totally don't pay any attention to home price appreciation, or they go the direction of not paying attention to positive cash flow and just totally speculating and hoping the market value will go up. Jacksonville represents a wonderful combination of both of those. On the downside for Jacksonville, we are not going to have as strong of cash flows as you may find in another market, let's say in the Midwest. We're still positive, like we were just talking about, a couple $100 a month. So that's substantial, but you may find a higher return just based on the cash flows by going to other markets. But in that other market, while they may have slightly more cash flow, if you look at their historical home price appreciation metrics, they just can't compare to Jacksonville. And the way to think about home price appreciation is not in the short run. To be able to count on home price appreciation, you need to look at it in terms of a full market cycle. Because if you look over the history, full market cycles, you'll find that home price appreciation rates in your market tend to repeat themselves. If you look at 10-year, 15, 20-year segments of time, you'll see that the average home price appreciation rate is pretty close to what the historical home price appreciation rate for your market is. So if you are a buy and hold investor, you can count on home price appreciation if you are in for a full market cycle. And so that is the fourth profit center. And home price appreciation, if you had to compare all of the profit centers, it will have the biggest impact on your overall return on investment. And that's why you just can't turn a blind eye to it.
All right, Greg. Well, this is where I say we're going to pop in the historical average home price appreciation here for Jacksonville.
That's right.
So that you see the spreadsheet work. It's magic. And the spreadsheet did not work. It's magic.
Well, that's interesting.
That is the first time that happens, huh?
That's pretty funny. I don't know what's up with that. I don't know. We'll have to go back and check that out.
Yeah. We'll have to go back and check that out. So, Greg, talk me through this. So normally what happens here is we pop in this 4.3% home price appreciation under the assumption that you're going to be in for a full market cycle and you can count on 4.3% home price appreciation. Mm-hmm. And what you'll see is these numbers here on the right will go up. This like cash purchase, this non-recourse purchase will go up about 4.3%, a little bit more. And then the conventional total ROI financing jumps up to like 23, 24%, right?
Absolutely. So it's working for the cash purchase and the non-recourse purchase. It has worked literally every other time for our conventionally financed purchase. So I assumed it would work now. I don't know. Maybe I screwed up. Maybe I hit a sell or something. I don't know. That's interesting. So yeah. So what that's showing is that for your cash purchase, including home price appreciation, if you are investing for a full market cycle, holding for at least 10 to 20 years or more, you can count on it being somewhere around a 9% to 10% return on investment. Same thing if you're buying with non-recourse financing. If you're buying with conventional financing, though, as Pablo was talking about, if the evaluation was working correctly, don't you guys just love a live show, by the way? There you go. We're just going to roll with it, right?
The beauty of live, man. The beauty of live.
What you would see is that return on investment skyrockets. 23, 24, 25%, somewhere around there is probably where it would be. And the reason that happens is because when you're investing with conventional financing, you're only putting down either 20 or maybe 25% of your money into the deal. And the rest of the money is coming from the bank. So as the market value goes up 4% a year, and you're only putting, let's say, 25% down, you can actually multiply your return on investment 4 times. So a 4% return in market value actually is a 16% return on your money from that. And so you add 16% to the roughly 9 or 10 that we had prior to that, and boom, you're at 24, 25%. And that is the beauty of leverage, which we can talk about all day, every day, because when you're trying to create a portfolio of rental properties that's going to help you reach your financial goals, you don't have to do it with financing, but it's a huge opportunity. It's something you should consider because it really helps get you there faster while also taking on the right amount of risk, right? You don't go hog wild. You don't go finance everything to the hilt. You can still do it while making sure that it is a risk-adjusted return on investment that you're looking for.
Yeah, man, that was a major eye opener for me as we started doing the show more often. For those of you that are new, I'm not a real estate expert, right? I am the guy in the room that asks the questions that people are ashamed to ask because I don't have shame, and I know that that's my role, right? Like I'm here to be your voice. Now, when I realized that, that leverage piece, the idea that if in rental income property investing, you can put down 20% on a $122,000 property, 25% on a $22,000 property, right? $122,000 property. All of a sudden you're investing $30,000, but you're getting the appreciation on $122,000. That really, really blew my mind. But,
Hmm.
again, I'm the guy that asks the questions that nobody wants to ask, but we've got a ton of questions to be asked here in the chat. So we're just going to go straight in there. Right before we get into that, I know we got a bunch of new people. I just want to encourage you. We have a Facebook group called the Rental Property Investing Facebook group that has over 2,000 members in it. That's 2,000 people that are investors in real estate, want to be investors in real estate educators, JWB customers, contractors, like all the sorts. And there's a great, great community. I'm going to put the link here in the chat, jwbfacebookgroup.com. I hope you join us in there because it's really we used to call it our secret cool club. Now that it passed 2,000 members, it's kind of not a secret anymore, but you can still get in the cool club, even though it's not a secret. So I'm going to put it in the chat, but let's
Hey,
start
Pablo,
with, yeah,
can I jump in just 1 second? Lee
please.
posted in the chat there that I didn't share the fifth and final profit center.
You're right.
So
You're right.
that would be just the ultimate, not cool cliffhanger that we left there. The fifth profit center is inflation hedging. And this is another one that folks may not really kind of get excited about or really maybe fully understand. But, over time, this is incredibly powerful. When you're investing in a tangible, hard asset like a house, what you find is that as the value of goods and services go up around you, which is inflation, generally you're going to see that rent rates and home prices go in line with inflation. That's the hedge against inflation that you're looking for. You don't get this with paper assets, right? They're not generally tied to what the goods and services are going on around you, right? So this ability to hedge against inflation is one that is really powerful. And then if you use debt as well, the ability to profit from inflation is kind of supercharged, because as you take out debt today and then inflation happens, you're able to pay that debt back in less valuable dollars. Which kind of, the first time I heard about this and really trying to spend some time understanding it, it didn't really like move me or motivate me or whatnot. But when you think about it, like, if inflation is 3%, then you're really paying down 97% of the loan next year, just because of inflation, devaluing your dollars. So it is really, really powerful. Although we don't talk about it a whole lot. It's something certainly to keep in mind, and a great separator. So those are the 5 profit centers for rental property investing. And you are muted.
Of course I'm muted. I'm not anymore. Before we get live entertainment, folks.
Left you speechless.
Before we get too far down the road, I'm gonna zoom this question to the front of the room here, because we were just on a radio show yesterday where we got interviewed about 1031 exchanges. And Roberta Meeks asks, with a 1031 exchange, how can you leverage that since you're required to put your gains back into the exchange of the property?
So a 1031 is an incredibly powerful tax deferral strategy. And again, many people aren't so fired up about tax deferral strategies because you don't really see the impact of it. But especially in rental properties, being able to acquire additional assets because you don't have to pay the taxes today is huge. So I'll give you an example, Roberta. So we were talking about this on the show yesterday, the radio show. And, let's say that you're an investor in California and you bought a property. What did we say? 600,000 is what you bought the property for in California. And then the market value went up. Now you do have to hold on to the property for at least a year. It has to be an investment property. You have to hold on to it for at least a year. And let's say that the value of that property after that time is 800,000 and you sell it. Well, you've got $200,000 of a gain. If you do nothing and, just take that gain, when it comes tax time, you're going to pay long-term capital gains on that. And I'm going to simplify it. And I'm not a CPA, so everybody needs to do their own due diligence. We'll just throw that out there. I'm just a real estate investor who's lived it for 15 years. But, generally long-term capital gains are somewhere around 20%. we're going to go with that. That $200,000 that you earned, now you take $40,000 away from that because you had to pay 20% on the gains. That's $40,000. And you're left with $160,000 of investable capital. Now, what you can do to maximize that is you can go to a market like Jacksonville, which has better cash flows. Those 5 profit centers are stronger. It's a better risk-adjusted return because you get positive cash flow, which you're probably not getting in California, and you can build that rental property portfolio in Jacksonville. Let's say that the down payments for each of your rental properties is $50,000. So boom, you took that one property that probably wasn't earning you any cash flow in California, and you didn't do the 1031, and you came to Jacksonville and you bought 3. And each of those properties, let's say, produces $250 a month in cash flow. And now you created $750 a month of an income stream for yourself. What's that? $9,000 for the year, somewhere around there, give or take, right? Very cool. Very cool. That's how you just maximized it. Now you have to use an intermediary. You have to go through the right. Actually, we haven't gone through the 1031 exchange yet. We've done it without the 1031 this way. So that would be an awesome move. Now, if you want to supercharge that and use a 1031 exchange, here's what you would do. You would sell that property. You would make that $200,000 as a gain. Then you would follow the rules to do what's called a 1031 exchange. They're very specific, but they're not hard to follow. You have to use an intermediary. You have to identify the property a certain days in a number of days, and you have to close on the property in a certain number of days. Working with a provider like JWB, you never have to worry about those timelines. It's easy. We can make a 1031 exchange happen much quicker than those timelines. But now you've got that $200,000 gain. Well, guess what? You don't have to pay the taxes on the sale at that time. You can now repurpose that $200,000, that full $200,000, to go and buy assets in Jacksonville. Prior to this, you can only buy 3 because you had $160,000. Now you can buy 4. You can buy another asset that with those 5 profit centers is going to create a substantial amount of wealth for you long-term. That is very simply the difference right there. Difference being able to buy 3 properties or 4 properties from your sale of your California property. So, that's a very quick and easy example of how a 1031 can create maximum value for you, especially in a high price market like California.
Gregg, I missed the beginning of what you were saying because there's a ton going on in the chat and I'm trying to engage with people and make sure that there's a lot of questions. We got to get to them. But did you talk about how using leverage from that 1031, how you can take that and turn that into multiple down payments? I wasn't sure if that's what you said because that was the question.
Yeah, okay, absolutely.
Cool.
So, you can take that $200,000 of that lump sum. You are not inhibited by the taxes that you have to pay at that time by using the 1031 exchange. And you have an option. You could take that $200,000 and buy 1 property in Jacksonville. That's certainly a possibility. Or if you really wanted to supercharge this, then you could take out 4 loans for 4 properties. Still, your amount invested would be $200,000 in Jacksonville, but it would now be over 4 properties. And this is going to give you a higher risk-adjusted rate of return, as well as creating really a consistent portfolio. Instead of 1 asset, you now have 4 assets. And in rental properties, that's really what you need. You need to have multiple properties in order to be consistent.
Okay, living up to my name, asking the dumb questions. All right, let's get into the smart questions. Lee Bishop asked, I'm going to share the property here because he's referring to this property now. Lee Bishop asks,
you know what? Is Lee going to come on video? I know Lee's a little bit, he's up for new stuff. Is he going to come online?
I'm sure he will, but we literally have 20 questions, man.
Okay, all right, cool. I'll stop.
Let's get into this stuff. Yeah, he already raised his hand. Of course, Lee. Lee, we love you. You were the MVP of the Not Your Average Investor show. Let's see if we got time later on for Lee. Lee says, things jumps out to me about this management fee is higher than 1 month rent. Is it due to it being a rehab and not new and lower than normal purchase price of $122K? So I guess he's saying that the management fee seems high. Do you have anything to say about that?
No, it's 10% if I'm doing my math correctly. 900 times, go to that cell, B29.
B29, bingo. All right.
Yeah. So Lee, all we're doing is we're taking the monthly lease, which is cell B25, $900 times 12, and then we're multiplying 10% of that. And so we charge the 10% monthly management fee to do all of the rent collection, to manage the relationship with your resident, all the accounting, all the customer service, facilitating any maintenance items, all that good stuff. So it's just 10%.
There you go, Lee. Jag Chata asks, hi, JW. What about vacancy reserve and maintenance / CapEx reserve? Do you not deduct that as well to get cash in hand / cash on cash?
Yes, great question, Jag. So, and if we would, let's go over to those property assumptions there. There we go. And let's take the appreciation rate out of there. Let's go back to 0%. So we do take into account your expected maintenance and vacancy rate. And we make it really simple when it comes to maintenance percentages. So we include CapEx, which is capital expenditures. For those who might not be familiar, that's all of your big ticket items that you would need to repair, right? A roof or an AC or anything like that. Now, first of all, we don't sell properties with deferred maintenance such as those items. But listen, if you hold on to a property for 20 years or longer, like I do, you're going to have to replace those things. So we have taken all of those expenses over the years into account when understanding what those percentages are. So the vacancy rate is 4%. That means that out of the gross rents that are collected for the year, you should expect 4% to be given back in terms of a vacancy cost. For those of you who want to kind of follow along at home and do the math, you'd take $900, which is the monthly rent, multiply it times 12 and take 4% of that. And that is the real dollar amount that you should expect to give back on an average annual basis in terms of lost potential rent due to vacancy. That's what your vacancy cost is. Similarly, maintenance rate. Now you see 9% here. Now this is higher than some of the other property of the week properties that we have put in front of you. Pablo, do you remember why we do it? Why it's a little bit higher here? And I've left you speechless again, brother. Your mute game is on fire today.
My wife is not working from home today, so I'm worried that the dogs are going to bark if the Amazon guy shows up, right? So like I'm like overactive on mute, and I'm overactive here in the questions trying to sort stuff out. Can you repeat the question to me, please?
Yes, absolutely. So do you remember why we're at 9% for the maintenance rate, whereas that's a higher rate than on our other properties?
Yeah, because this is a renovated property, and normally people are used to seeing like a 6% number. That's like a standard thing that you get from a magazine because that's what people say it is. But JWB, having done this over 3,000 times, is using real live scenarios and real live data. So you guys actually put in real numbers depending on, is it septic, is it sewer, is it reno, is it new, what part of town it's in. So these are much more detailed numbers, which is why I use that 9%. How'd I do?
You did great, man. You did great. And you mentioned one thing. So 9% is higher than you would expect across the industry. But you mentioned one thing that really is important when looking at a 9% maintenance cost. Is it septic or is it on city sewer, right? What we have seen through all of our data, which I don't know another turnkey provider that has this type of data. So they're probably not sharing it with you. But what we have seen is that properties that are on septic, we love. I own many of them. Clients own many of them. But what we know is that there has to be a slightly better deal involved to be able to get a septic property because we see higher maintenance costs over time. And so that's that 9%. 9% of the gross rents collected each year should be held back for a property that's on a renovated property that's on septic. That's what the number tells us. So for you, it is perfectly fine. I love investing in properties, even if they have septic or whatnot. I just need to be prepared in advance. And that's the way you should look at it. If you know that being on septic for a property is the type of property you're looking at, that is totally cool. Just build in more expected maintenance costs. We happen to have the data here and it shows that 9% is the figure. If this property was not on septic, it would be a lower maintenance cost. And all things considered equal, it would be a higher return on investment, probably a higher purchase price as well to purchase it. So by buying it at a septic, generally speaking, you're probably going to be buying it for a lower price than a similar property that was on sewer. And that just shows you that you just have to get a slightly better deal if it's on septic. But I think Jag's original question was this included in the return on investment calculation. Everything I just talked about there is included in that 9.74% expected return on investment for this property.
Got it. Jag had a follow up here in the chat that I'm just going to pepper in so that it's still contextual. He says, so that leaves $77 per month in hand as real disposable cash? Question mark. Is that, did he kind of misunderstand that?
Well, I'm not exactly sure on the $77 number, but I think I get what he's trying to say. So if we're talking about that total return on investment calculation, we're taking into account all things. So we're taking into account your tenant placement fees. We're taking into account your maintenance cost, your vacancy costs. We're taking all of those potential negative items. Now, not all of those happen every single year. Not all of those happen every 2 years or 3 years. Like, for example, we count a full year of tenant placement fees in that calculation, whereas our average resident stays 54 months. And if your resident stays 54 months, then you only have a new tenant placement fee every 54 months. So I'm not exactly sure on the $77 thing, but I think what we may be missing is the tax savings and the principal paydown component, Jag. So when you do all of that, when you take into account the tax savings and the principal paydown, and you also take into account all those negative items, you're going to see 9.74%. Now, the disconnect might be that $194. So that's a simpler number. So that doesn't take into account tenant placement fees, maintenance costs, or vacancy costs. And it also does not add back in the other profit centers, such as tax savings and principal paydown. Now, if you only take all the negative items and you don't include the positive items, then you're going to come up with a lesser number. Maybe $77 is that number. I don't have the quick math in front of me. But I bet, Jag, you're including all the negative items and not including the positive items. That would be my guess to kind of coordinate all of our numbers here.
Yeah, and again, that's a cash on cash return. That's a different number than conventional monthly cash flow, right? Like that 194 is just cash flow. That is what's going into your bank account every month when there isn't these one-off things that happen every couple of years or whatever, right?
Yes, exactly. True cash on cash returns. People calculate them different ways. The real way to do it is to calculate all of the items that would affect your cash flow that year, and also take into account your closing costs. Very few providers do that. It's kind of like the wild, wild west for every provider. So it's really great to have one standard way to look at your property evaluations and just roll with it and make sure you're comparing apples to apples.
Cool. All right. Nam Gwyn asks, do you charge a fee for moving a renter into a property?
Great question, Nam. We do. I would imagine most, if not all, property management companies do charge a tenant placement fee. And so our tenant placement fee is equal to 1 month's rent. You'll generally see tenant placement fees somewhere between a half month's rent to a full month's rent. So ours are a full month's rent. And let's talk a little bit more about the value that a tenant placement fee can create for you. So most property management companies are only going to sign 1-year leases. And when you only sign 1-year leases, you're setting yourself up for a new tenant placement fee every single year. And the biggest correlation between your success as a rental property investor is how long that resident is going to stay in your home. So Pablo, I'm going to put you on the spot again, brother. All right.
All right. Thanks for the warning.
You just bought your first JWB property, or you're in the process of closing, right?
Yes.
And I don't remember exactly. Is your home rented at the moment? Do you remember?
My home is rented at the moment. Correct.
Yeah. And I think it was on a 2-year lease, right?
That's right. 2-year lease.
Okay. So if Pablo is buying a rental property and that resident only stays 1 year, every year he's going to have that tenant placement fee. Even if he only got charged a half month's tenant placement fee, after 3 years, chances are that he would be paying 1.5 times the monthly rent in tenant placement fees in 3 years. For JWB, we take a different approach. We are all about driving long-term resident stays because that is going to decrease your maintenance and your vacancy cost. And so the way that we do that is we only sign 2- and 3-year leases. Unless there is a huge exception, we're going to sign 2- and 3-year leases, and we're going to renew our residents at an incredible clip. Just got out of the annual meeting. We reviewed all of our numbers with our team. We renewed 71% of active leases in 2020 that came up for renewal, which is unheard of. I was speaking with a new member of our team who used to work for a different property management company. She stopped me in the hall and she said, Greg, she said, we just accomplished 71%. She said, you want to know what our goals were at the other property management company? And I said, yeah. It's hard for me to kind of get goals from other property management companies. So I'd love to hear that. I always thought it was somewhere around 30% is what other property management companies would renew. She said the goal was 20%. And one time we hit 23% and we had a big party. So most property management companies don't focus on it. So at the end of the day, when you're looking at tenant placement fees, look at the cost, but also look at the average duration of resident stay. Ours is 54 months. Our tenant placement fees are 1 month's rent, and we sign 2 and 3 year leases. And generally, it is going to be a huge value to you if you can work with somebody who is going to sign those types of leases and renew at that type of a rate.
Awesome. That's a really cool little data point that you got.
Yeah, I was stoked. I was like, I'm totally sharing this on the show.
Yeah, for sure. Tony Borman asks, I know certain streets in this area of Jacksonville can be pretty rough. And I noticed the estimated appreciation is 0%, right? Which we tackled in our faulty spreadsheet here. So I'm guessing the area isn't improving much. What things should investors consider given this is a C-ish area? So
Great.
clarification, we had the 0% in the appreciation box because we like to do the teaching lesson of JWB doesn't know if you're in for a full market cycle. So it is speculative if you're under that. If you're in for a full market cycle, 4.3% average is the appreciation rate. But what are the considerations in this kind of like C area?
Yeah, absolutely. So it's important to know that just because you're in a market that is a below middle income neighborhood, that may have zero correlation with your average appreciation rates. If you actually look at some of the neighborhoods that are C neighborhoods in Jacksonville, they are some of the highest appreciating neighborhoods in Jacksonville overall. And that would blow some people's minds. If I even went one step farther, some of the D neighborhoods in Jacksonville that we do not invest in have actually had some of the highest year-over-year appreciation gains over the last 5 years. That would blow some people's minds. So many people look at a C neighborhood or a below middle income neighborhood and they think no growth. That may have also been what you thought because you saw 0% on our evaluation. But that's not the reason you see 0% on our evaluation. As Pablo said, I'm a very big believer, and what the data shows us is that you have to be a buy and hold investor if you want to count on home price appreciation. You have to be investing for a full market cycle. Anything less than that, speculative. And when it's speculative, I'm not going to put it on our spreadsheets. So that's the reason that you see 0%. It's not because of a lack of growth potential in that neighborhood. But I do think you hit the nail on the head as far as that being a below middle income neighborhood. That is where we love to invest in Jacksonville, meaning those neighborhoods that are below middle income, that have low prices, high rents, and are surrounded by jobs, and are in neighborhoods that we know and love and have a ton of experience investing in. I've got a number of rental properties right there around Fifth Avenue, been owning properties since 2006 in these neighborhoods. So that goes a lot into our ability to discern which neighborhoods are right. But this neighborhood you will see is a neighborhood that has below average schools. This is a neighborhood that you will see that has, I'm going to say it's not going to have violent crime, but there's going to be some crimes like vandalism and things like that. I don't know if we have, I know one of the times here, we're going to talk about Truly a Crime maps, and many investors go to Truly a Crime maps to go and kind of do a little bit of digging to see what the neighborhood looks like. And they'll give you kind of a color scale of kind of crime activity. So you can, that may be where you're kind of seeing that. Very cool to go there and take that into consideration. But I think the real thing to kind of just address directly is that to be able to invest in rental properties, you have to be comfortable investing in below middle income neighborhoods. Low school ratings are commonly found in below middle income neighborhoods. And the reason why we love these neighborhoods is because, going back to those 5 profit centers, we believe and we have seen that the 5 profit centers are the strongest in a risk-adjusted return on investment in below middle income neighborhoods. Would I love to invest in the nicest neighborhood on the beach in Jacksonville? I certainly would. But if I did that, it would create more risk for me as an investor, because every month I might be $500 negative cash flow every single month, right? That is substantially more risk to this investment. And we do not invest in violent crime neighborhoods. I don't want to give the wrong impression that we would go into rough neighborhoods. There are many neighborhoods we are not going to go into, but I just kind of come directly and let people know, for this to really work for you, you got to be able to invest in a place that you may not yourself want to live. It has to be a separation there, because you can create great value and have great residents in some homes that are in below middle income neighborhoods. And that's how the model works.
Yeah, one of the things that I learned in hosting this show throughout the COVID pandemic is this idea that once you get into the higher income neighborhoods, those are homes where people are making a decision of, do I upsize a home with this money, or do I invest it in the stock market? Versus these lower middle income class neighborhoods are, I need a home. This is all I'm going to be able, this is what I can afford. This is a necessity for me as opposed to a luxury. And that really, showed in the fact that y'all collected your rents throughout COVID at like 97.8%, right? Like the risk adjusted piece. I just want to contextualize for people that, haven't been around all year like I have and had these amazing moments. Chad, I had a quick follow up there. How long is a full market cycle? I think you can answer that quickly.
Yeah, between 10 to 20 years is generally known as a full market cycle.
Great. So Nam Nguyen has another question. Can your numbers be adjusted if I were to pay cash with or a 50% down, etc.? I'd like to see how you do it so that I can do it for myself in the future. I think we're going to pop open the spreadsheet and hope that only that one.
I feel pretty good about it working, except for appreciation. So we'll be good too.
Greg, we've done so many of these and been so interactive with it, and nothing has ever gone wrong. And now I'm like disoriented.
Yeah, no, this would be a great exercise. It'll work. I've got faith there.
All right. Cool. So where do I go here?
Yeah. So let's first go to the analysis cash page. Analysis. Okay. So analysis cash, let's go way up to the top there. And if you want to zoom in, really the top is probably the best, because that'll give the big numbers there. And okay. So when it's a cash purchase, what you're able to see, if we're looking at the top, is a purchase price of $122,000. You've got, your down payment is 100%, right? That's the cash purchase. If we go over to the rental assumptions to the right there, we're able to see the rent range is the same. The actual rent amount is $900. And your total initial investment is your down payment plus your closing costs. Closing costs for a cash purchase are a lot less, right? The lender is not making money because the lender is not performing a loan for you. So your taxes, or your property taxes and insurance largely are what your closing costs are. So you're all into the property for $123,500 for this property. Now, at the same time, your cash flow is a lot higher too, because you don't have that loan. But the interesting thing is, if you look to the far right there, a total ROI, your return on investment from that cash and from those profit centers is lower, right? It's 5.59%. And so what that is showing is that even though you get more positive cash flow in your bank account, which we all love, you had to put your whole amount of cash into the deal. And so you're not able to use leverage to your advantage. And a higher monthly cash flow over you putting way more money into the deal still nets out a lower return on investment. So cash does work for some folks. And what we do is work with our clients, especially before they come on board with us. We're building a plan with them and understanding if cash is the right thing for you, if using non-recourse financing is the right thing for you, or if conventional finance is the right thing for you. And sometimes cash is the right play. But we do it knowing full well why it is. And we know that the returns on investment are going to be lower because of a cash purchase.
All right, there you go. So do we want to go and do the 50% right here? Conventional
Yeah,
finance?
let's do it. Well, let's go to, let's do that. That's cool. Let's do that. And this is a cool thing because anybody can actually go ahead and get our spreadsheets that work.
That's right.
For appreciation.
That's right. You were able to download the fully functional spreadsheet that doesn't have one cell wrong at, what is it? JWBwebclass.com. You get the free investor toolkit.
Yeah, absolutely.
Yeah, so that's at JWBwebclass.com. There's a 20-minute webinar. You can go there and get like all the breakdown of how Gregg explains all these basic concepts. Like CJ, for example, for you, I think it'd be really good. You get a lot out of that. And you download a spreadsheet of these that you can use for all of your investing. So Gregg, am I going down here and putting 50% down payment?
Let's put 50% there. But, before you do that, go to the right because I want to see what the return on investment is because we're going to use it as a teaching opportunity to show the difference there. So, all right.
Okay. All right.
Well, and you haven't pressed the magic button. It says 50% there, but it's still reflecting 25%
Correct.
down.
Correct. So now I'm going to press the magic button.
There we go. So what happened here is our total return went from 9.74 down to 6.99%. It went down. Okay. But if you also noticed, our cash flow went way up. Okay. So what's happening here is we have a lower loan amount, which leaves us with a lower principal and interest payment, less expenses, which nets us a higher monthly cash flow, which is awesome. But at the same time, we had to bring more money to the deal. So our total initial investment went way up as well. And so when you get a higher monthly cash flow, but you had to put way more money into the deal, it's the same thing that happened with the cash purchase. Your total return on investment from those 3 profit centers actually comes down. And this is why folks generally will put 20% down or 25% down. And that in a nutshell is why leverage is so important. It basically gets the most out of those 5 profit centers that we've been talking about.
There you go. Greg, I'm gonna jump ahead here and just say we still got a bunch of questions. I don't have anywhere to be till 2:00. You got some extra time so we can get through all of this?
I think we've got till 1:45.
Till 1:45. All right, let's hit it.
Yeah. And if for any folks that we're not able to get to, go to the group. What we have found is folks who post their question in the group, there are literally 2,000 investors that are super happy to help you. And I will be in there to answer your question later as well. So if for whatever reason we don't get there, I would highly encourage you to go there. Thank you for posting the link there, Pablo. We will get that answer for you one way or another.
All right. And I like how you said Pablo. All right.
Pablo.
So, all right. I'm going to rush this one to the front because I know you like answering this question. Rule Papa asks, my rule of thumb in rental is if I buy a rental property for $100K, then it should rent for at least $1,000 a month. Is that a good rule?
I love that rule. It's just not possible in passive income rental property in Jacksonville. And so you have to decide what's most important to you. If you are dead set on the maximum number of positive cash flow for you, then that rule, it probably will matter more to you. And that will probably lead you to a market that has lower prices. And that might be a market in the Midwest. It might be a Kansas City or a Cleveland, Ohio. And we can talk about Cleveland a lot because, I'm a huge Pittsburgh Steelers fan right now, and I'm never going to waste an opportunity on playoff week to talk about the Cleveland market here, which I will do in just a second here. But you're not going to find a market that has above average long-term home price appreciation and the 1% rule right now. You may find that and you might have to go to a D neighborhood, like the place that you don't want to own rental properties, right? Something's got to give. And so what we have found in Jacksonville is below middle income neighborhoods that are decent, hardworking neighborhoods that we want to be in a growth market that also has positive cash flow. So that's why we like it. So the 1% rule is something that it can be overused. People can fall in love with it. And what they do is they go to some of these lower price markets like a Cleveland. Maybe you can hit the 1% rule. But if your plans are to hold onto this property for a full market cycle, what you're going to find is that you're going to give up a lot in home price appreciation. And the biggest driver of your returns actually is home price appreciation. So my whole goal with owning rental properties, I don't get so excited about $250 here versus $200 here. For me, I want it to pay for itself. I want it to be a great experience. I want it to pay for itself every single month. And then I want to be investing in a market that has shown to appreciate more than other markets. Cleveland, I happen to know off the top of my head, since 1991, year over year, on average, it's appreciated at a rate of 2.3% on average. Jacksonville, during that time, has appreciated at a rate of 4.3% per year on average. This data is coming from the Federal Housing Finance Agency. If you take a $200,000 home and you extrapolate that out for a 20-year or a 30-year hold at 2.3% appreciation in Cleveland versus 4.3% appreciation in Jacksonville, the difference will blow your mind. it is hundreds of thousands of dollars of additional return for investing in a growth market like Jacksonville versus investing in a market like Cleveland. And so when folks get so excited about positive cash flow, I love positive cash flow too, but don't have blinders. This is my personal opinion. It's how I've been investing and how we teach our clients is don't forsake home price appreciation, right? The biggest impact to your financial well-being after holding on for 10 or 20 years is not going to be your cash flow, right? It's going to be how much did the home appreciate over the long haul. So 1% rule, 1% rule and that positive cash flow can be a great strategy. I would probably gear you more towards a market though that maybe you're not planning on holding for a full market cycle. That's a place that it certainly might be better suited for. But you know, the total return on investment after a full market cycle, I think it's going to be hard to compete with the market that does have both positive cash flow and significantly higher home price appreciation.
There you go. There you go. I know you like answering that one. I got a question here. So CJ Pindat, who's new here, he's been waiting patiently to ask this. And I'm going to share the screen so that there is context here and share screen. And he asks, CJ Pindat asks, what is the middle type of financing, meaning non-recourse financing? I've only used cash and occasionally conventional. And two, does JWB, or I guess he's got two questions. Well, so talk about non-recourse financing, Greg.
Non-recourse financing, when you hear that, you should think about financing in your retirement accounts. This is largely what it's used for. When you want to actually buy properties in your retirement accounts, many people aren't aware that you can do that. And even less people are aware that you can actually get a loan for it. But you can't go to a regular bank. They don't do loans to your IRA or to your 401k. You have to go to a special lender to do that. And it's called a non-recourse lender. So that's what that is. That's what a non-recourse loan would be.
Yeah, there you go. So again, for me, that was a major ground shift moment when I found out about that as host of this show, that I can take my old Roth IRA, or in certain cases a 401k. If you have a solo 401k, you can take all that stuff that you had rolled over and was just sitting there making like 3% or 2% or 9% or whatever, and invest in a rental income property inside of your portfolio that you're now owning a home, and it's generating all this cash flow that can be reinvested. Question number 2 from CJ Pindat. Does JWB actually pay closing costs, or where is that included in the sheet?
So JWB pays the seller closing cost and the client would pay the buyer closing cost. And that's done in a traditional manner according to Florida real estate. So there's really, we don't pay additional closing costs for the buyer. It's pretty much by the book here in Florida is how it's divided up.
Okay. Number 3, how far out should you plan for a 1031 exchange? I've had a property that's gone from 60K to 200K and the tenant is going to move out. Thanks.
Wow, that's incredible. And that is such a huge opportunity for you, especially because you're thinking about matching that with a 1031 exchange. So congratulations. You know, generally the best thing to do is when you are thinking about putting that property on the market for sale is when you should be kind of getting your ducks in a row for the 1031 exchange. You know, at that point, once the property's up for sale, hopefully you get a contract soon. Really, at a minimum, you know, you need to have your 1031 exchange administrator identified. You know, for JWB clients, this is something that we help you out with. We, of course, are not a 1031 administrator or a custodian, but we have somebody in our network that we work very closely with who's able to facilitate that process for you. So generally, whether you're going with JWB or with another turnkey provider, really when you start to put the property on the market for sale is a good guess. But I will point out some pitfalls. When the 1031 has rules assigned to it. One of the rules is that you have to have your replacement property identified within 45 days. And you can have a few of them, but you have to have the properties that you're targeting to purchase identified within 45 days. In a normal real estate market, that's kind of tough. In a market right now where inventory is incredibly low for other turnkey providers out there, it's going to be really hard for you if you go with another turnkey provider other than JWB. So I'm coming at you with the expectation you probably are coming to JWB or another turnkey provider that has inventory. If you are going at it alone, you may not be able to find that property within 45 days. You probably want to kick that timeline out to start the process well before you actually put your property on the market for sale. And then the last rule is that you have to close within 180 days of selling your original property. Again, really important. If you don't follow that, if you don't use an administrator and you don't follow those timelines, you can potentially lose out on the benefits of a 1031.
Greg, sounds to me, so CJ, he's in Memphis. He's trying to diversify out of Memphis. He's looking for this, thing. I feel like CJ, for you, you're probably somebody that wants to go to chatwithjwb.com so that you can just hop on a call with our team and anybody else. This is open to anybody, right? Like if you have a personalized question that you want to hop on our team and you want us to answer one-on-one, you go to chatwithjwb.com. But for you, CJ, if you need to, start identifying that property or whatever, I think that's probably the right move for you. It's real easy. You calendar invite, super value add call. I've done it. Like Greg said, I just recently invested in my first rental income property, and it's all that first call is really like value seeking. So it's like, what are you trying to do? What are you trying to accomplish? Stuff like that. So I suggest you go to chatwithjwb.com there. And all right, let's keep going. This is kind of a funny message from Leo in the chat. Leo puts, "Welcome back, Leo. Leo is a valuable member of our community here. What I learned from this show are cash flow and not getting emotionally attached to the property. I got into trouble back in the middle of 2000s as my investor partners, my mom and sister, mom overruled us. Didn't want to sell the property in Sacramento, California that we got. We got almost 200% appreciation in 5 years on that property. No cash flow, all liabilities on monthly mortgage. Then 2008 came crashing, ended up short selling it. And these are the things that I learned from this show, opened my eyes and hoping for the best moving forward. Lessons learned, don't invest with your mom, LOL."
Wow. What a cool story, Leo. Thank you for sharing that. It is really cool, Leo. I know you've been a part of this group for a long time, and I know you recently put your first home under contract with JWB. We're super excited for you, buddy.
Yeah, very cool, man. All right, so Jag Chatta, welcome. Jag is another one of our new members here. He asks, is there any warranty on the major items for the homes for you?
Yes, absolutely. So if it's a new construction property, there are a number of warranties. Generally, it's about a year for most of the items, your major mechanicals and things of that nature. They do vary a little bit more from that, and we would, of course, give you a full warranty sheet at the time of purchase. That's for new construction. And then it's generally very similar for your renovated homes as well. Again, there's more variables and whatnot, but generally about a year is what you should expect as far as warranties, whether they're new construction or renovations.
All right. Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
Marilyn is a regular on the show, as we all know. Do you know if there will be any new changes or laws regarding 1031 exchanges in 2021?
I do not know if there are any changes. I think our political leaders have a lot going on right now. And usually in the first year of a new president coming in, very few things are actually done from a tax perspective. That's just kind of generally what we have seen. It takes time to get their tax plan to go through, and then it gets approved and then implemented and all that good stuff. So I would feel pretty confident. This is just me. I don't have any extra additional insight into this than most of you probably do, but I don't see anything changing for 2021. There were some rumblings about 1031s potentially changing in the future. What I also read is that has been brought up many times during election cycles, and that hasn't ever changed. Well, it hasn't changed recently, as far back as I can remember. So I don't really know. I'm not expecting that there's anything changing in 2021. I would be really surprised if something changed going forward. It just doesn't seem to make a whole lot of sense to me personally to kind of decrease that liquidity in the real estate market by not offering 1031 exchanges. But we'll certainly keep you posted. I don't think it's something that you got to rush out and do right now because it's going away. I think you should rush out and do it right now because it's a really smart thing to do.
It is a smart thing to do. And let's talk about things that are an opportunity right now, Greg. Interest rates, right? Like we've talked a lot about interest rates and what the opportunity is right now. I think since you just brought that up and we're talking about urgency, talk about interest rates.
Interest rates. I think there's more generational wealth that's being created right now by people who have the ability to obtain loans than at any other time I can remember. And I've been investing for 15 years now. I mean, when I started to invest, I fully understood the power of using other people's money. And, in the first year and a half, I bought about 40 rental properties between my business partners and I. And I was a 23-year-old snot-nosed little kid who, and so for me, understanding that potential there was incredibly attractive because I understood the long-term benefits of it. But when I was doing that, I was getting loans at 7% interest, 7.5% interest. And I was still abiding by what we talk about here, positive cash flow, getting all those 5 profit centers. But my interest rates were 7.5%. I still have loans that are maybe not 7.5%. I've refinanced a lot of those now, but some of them are a lot higher than the interest rates you're able to get right now. And they're going to stay in place for a long time. For me, right? That's the thing about getting a low interest rate on a loan. You're going to be able to get an interest rate at, let's say, 4% for your investment property here in Jacksonville. That's going to be there when interest rates go back up, because they are going to go back up at some point, right? You're locking in that rate for 30 years. And as a tool to create generational wealth, the ability to access 4% debt, 4% capital, which is readily available for the majority of folks out there, I've just never seen it before. And when you couple that by investing in an asset that, number one, has positive cash flow, it pays for itself every single month, and then historically has shown to appreciate over the long haul, give it a full market cycle, history shows us it's going to go up in value. That is a recipe for generational wealth. That's why I went so big into it 15 years ago. It's why I still go so big into it. And it's why I'm so passionate about helping others do it, because I really think it's the best risk-adjusted return out there, especially if you understand the power of leverage.
All right, there you go. Yeah, for me, that really popped on my radar when we had the Rich Ritchie interview, who is a VP of mortgage for Truist Bank. And he was talking about how like this opportunity of mortgage rates, it's like akin to being able to like look in a crystal ball, see property values in 2011 and being like, I'm going to go all in, except right now you kind of can see the future because this is this like once in a lifetime extra cash flow, extra return for the life of a loan, right?
Mm-hmm. Yeah. So, I mean, to put it in context as well, when we started the show about a year ago, Pablo, we talked about our estimated returns. Do you remember what our estimated returns were?
Yeah, 7 to 9.
7 to 9%. That was January of this year. That was pre-coronavirus, pre-everything that's gone on, right? It was 7 to 9%. I can't remember a previous year. It probably was 5 years ago when estimated returns on investment were 9 to 11%. But because interest rates dropped like that, now that same property that was producing 7 to 9% return in January, now it's producing 9 to 11, right? So it is just like what Rich talked about. You're able to sort of like the deal is the debt. The deal is the debt. That is what I hope people take advantage of right now, because you are never going to see it again once interest rates go back up. And in my humble opinion, it's just, we've never seen a pandemic, and it's what it's taking to get interest rates this low.
There you go. So I'm going to ask, now I'm going Nguyen asked a really interesting question. And we kind of had like a NFL moment on the show, right? We got a couple people when you talked about the Steelers, we got, where are we here? We got Mark Henninger is a Steelers fan. Also Nadeem and Larry are both Seahawk fans. Bill Shields said Trevor time, baby. Marilyn Cotterman, who we just asked about, was a cheerleader for the 1972 undefeated Dolphins. My team. Wish I would have seen that. But Nam Nguyen asks, if the Jaguars move to the UK, will that impact the local economy for rental property investors?
It would. Yeah. I don't think that's the Jags and the city. There's actually a lot of really positive news that's coming out. For those who might not be familiar, the Jags, and Shad Khan is the owner of the Jags, has put together a proposal to bring an incredible entertainment complex in the stadium parking lot here in Jacksonville. It's called the Lot J project. And the city is potentially bringing to the tune of over $200 million in terms of loans or tax incentives to be able to make the project work. And, it would include a commercial district. It would include hotels. It would include a live entertainment district, something that we sorely are lacking in downtown Jacksonville, and really kind of changed the game. In addition to them being a very big partner in the shipyards project, which is a little bit farther out, but another game changer for downtown Jacksonville. So, you know, the Jags and the city they were close before, but they are potentially taking even stronger steps as far as locking the Jags in. That's a potential thing that the city wants, to be able to give that type of funding. But yes, to answer your question, if an NFL team leaves a city, I know that has an impact. So I don't think it's a high likelihood, but you know, if it starts to go that way, I'm sure it'll be a topic we'll talk a lot about here on the Not Your Average Investor Show, and we would prepare you accordingly.
All right, there you go. So we have a ton of questions. We're not going to be able to get to all of this. I really do want to encourage everybody, join the Facebook group. I'm going to download all these questions now. I'm going to send it into the team. We'll have however many of these we can have answered in the Facebook group would be amazing, because Gregg and I are coming to our final moment here, 145 hard stop. And really, though, want to welcome all the new people that came. I mean, we've had like 45 plus people on with us for an hour and 15 minutes on a Thursday afternoon. We never lose track of like how special that is. All this interaction. This is what we, you know, had in mind a year ago when we started this show. And now it's like, we got so many questions, we can't even get to them. And like, I want to serve and we want to answer it. But like, you know, there is just time constraints. So really the answer to this is, all right, Nam, I'm going to have somebody contact you. Nam said, Nam, go to JWB here. Nam is asking, can someone contact me? I'm looking to buy within the next 30 days. Nam, the easiest thing for you is go to chatwithjwb.com. That would be amazing. And you can just schedule a date that fits you. But either way, I'm going to forward this list of questions to Kate, who's our marketing person. She'll get with the sales team. Probably Courtney will be doing the outreach, right? It would
Absolutely.
be my guess. But we'll get everybody connected. But thank you, everybody. Next week on Tuesday, we have a really, really special show. This guy, Robin Dreek, who is this is different than stuff we normally do, right? Well, like we're normally talking real estate. On Tuesday, we're talking about trust. Robin Dreek was the head of the behavior analysis program for the FBI. He was a spy catcher for the FBI, and he's written a couple of best-selling books around his system for building trust with people and his system for determining if people are trustworthy. And we're just going to dive into that, because I think in real estate, you know, it's all about like, do you trust the people that you're working with, right? And we're going to just really dissect all of that. He's a rock star. He's like a $50,000 per speech, public speaker. He's coming to be on the Not Your Average Investor Show. Join us if you want to ask him a question. We can get into his story. He's got amazing, amazing stories and unbelievable advice. I've read both of his books. I'm a fanboy. I don't know if you can tell. So, you know, I had him on my podcast, and now he's showing up for the show because I've befriended him. So I think it's a really, really special thing. I hope everybody joins us. I hope, like we said, join the Facebook group, jwbfacebookgroup.com. And just hang out with us throughout the week, right? Gregg goes live in there. We answer questions. Sometimes we host watch parties. It's a good time. It's a bunch of really nice people with great information. And last but not least, Gregg, I'm gonna let you send us off. Thank you, everybody. Thank you for letting me be a part of it. Go for it, Gregg.
Just echo a lot of what you said there, Pablo. What a cool opening to 2021 for the Property of the Week. So many new people here with such incredible questions. It's really blowing us away. So thank you all for being here from all parts of the world. Just incredible. I am super stoked to be there with you and with Robin next Tuesday. It is going to be one of the coolest experiences. So I hope you all will join us, and I look forward to seeing you all in the group. Thanks, everybody, and have a great rest of the week.
All right. See you all later.